Coming up on today's program, stock market sentiment is in greedy territory and why that's a warning sign. Also coming up, margin debt is also a warning sign. It's at 10-year highs. Plus, Coinbase, the largest U.S. cryptocurrency exchange, is going public. Should you participate? I'll tell you what I'm planning to do. Stay with me. I'm Ron DeLegge with ETF Guide TV. It's great to see you. Thank you for joining me. I've got a few charts about the latest trends in stocks and Bitcoin that we're going to look at. We'll also take a look at stock market sentiment and the latest sector ETF performance. Plus, we'll examine the IPO market, where Coinbase is poised to become one of this year's largest IPOs. I also have a public service announcement and reminder about why it's so important to invest with an adequate cushion or margin of safety. If you're here for the first time, hit that subscribe button. And don't forget to check out my viewer resources section in the description area below. I've got online classes, free ebooks. I've got a portfolio grading service where I'll analyze and grade your portfolio. And now I'm excited to say I also offer one-on-one complimentary 15-minute consultations. So if you'd like to book your time, just a one-on-one with you and me, you can do that in the comment section or in the description section below. So before we go into the charts, I got a few audience comments that I want to share with you. This is from my good old friend GTO in Arizona, a longtime viewer and one of the few people who correctly spells my last name. So thank you for doing that, GTO. He says that Bitcoin should be called Bitcon. Well, there's no doubt about it. There's massive manipulation in the crypto market, just as there's manipulation in any market. This is going to change, though, GTO, over time as the Bitcoin marketplace matures and as it gets regulated. Some of these massive price discrepancies that easily get exploited today, well, that's not going to be so easy to exploit in the future, again, as this particular market matures and gets regulated. Here's a note that we got from Thomas P. asking about my recommended personal margin of safety amount. So, Thomas, I think you're a new viewer because you called me John instead of Ron. So it's Ron, but your margin of safety represents the portion of your overall investment portfolio that should be earmarked for capital preservation. That's all it does. And it complements, not competes, with your core and non-core portfolio. Now, to answer your question, Thomas, everyone's margin of safety dollar amount is different. And the exact amount is going to vary based upon various factors like your personal circumstances, your temperament, and both of these take priority over market conditions and any perceptions that you may have about the market being too frothy. I mean, never mind that. Set that aside. Focus on yourself, your circumstances, your temperament. And if you want to get more granular, I've got a margin of safety worksheet in my online class that will help you to calculate the exact number or percentage of your portfolio that should be earmarked for safety. Let's take a look at our first chart of the day. This is the CNN Fear and Greed Index, which has now turned greedy. Last week we were at neutral, and clearly market participants are getting pretty confident, and that could be trouble for stocks ahead. So caution is in order. I like to think of this reading as a contrarian indicator. In other words, you should probably be doing the exact opposite of market sentiment. So if sentiment is greedy as it is now, you should be fearful, or even better yet, instead of being fearful, best to probably be defensive. I pinpointed previous moments when we had the exact same level of greed and fear as we do right now. And right now, of course, we don't have much fear. We have lots of greed. But you know what happened every single time, though? That we were at the same point of greed in the short history going back to 2018, well, you'll see that the stock market corrected and fear took over. So looking ahead, that's probably going to happen again. So now's the time to get ready. Now's the time to be ready. What do they say about history? That's right, it repeats itself. Here's another look at the market's greed. This shows you the latest figures from the margin debt that investors have racked up. It's reached 10 years highs. And these numbers are from FINRA. And they do not segregate retail borrowers from professional investors, or I should say retail investors and professional investors. There's no distinction made in these numbers, but if we just look at the entire aggregated figure as we have here, it's pretty clear that all participants are borrowing lots of money to invest in the market. That's worrisome because overborrowing leads to over leverage. And one of the things that triggered that 1929 stock market crash was too much borrowing, too much leverage in the system. And that can definitely become a problem, especially when markets begin to sell off, because that just tips things over that much quicker because of all those margin triggers and margin sales. So let's take a look now at the big three U.S. stock indexes and the ETFs that track them. You got DIA, which follows the Dow Industrials, SPY follows SP 500, and then the triple Qs, NASDAQ 100. You'll see that DIA and SPY are leading the way, while the triple Qs are catching up, and they've had a sharp rebound since bottoming in March. And it seems like tech-heavy Qs are saying, hey, don't forget about me. I want to join the party. In a second, we're going to take a look at the month of April, which historically has been pretty bullish for stocks going all the way back to 1950. So that could be a good sign for the triple Qs to continue their run. Next up, we'll take a look at the IPO market, which has been very hot. And there's been an almost 300% gain in brand new IPOs over the past 18 months. My goodness. And this data does not include, by the way, the craziness of blank check companies, also known as SPACs. SPAC is the acronym. This is just IPOs. And as you can see, we've had a massive increase in the number of new companies going public as they're trying to cash in. And guess who's going IPO? Speaking of IPOs, yep, the largest U.S. cryptocurrency exchange, Coinbase, is planning to go public on the NASDAQ stock exchange. It's going to be a direct listing. Companies expected to command a $100 billion market cap on day one of trading. And this is just humongous. This, by the way, is an IPO I would not touch with a 1,000-foot pole. Remember, when companies go IPO with such big market caps, it means that pre-IPO insiders, they're the ones who got rich. While the post-IPO investors, that's you and me, that's the public, they get the leftover crumbs. And I don't know about you, but I do not invest to eat leftover crumbs. And that's what I think Coinbase is at a $100 billion market cap. It's leftover crumbs. And I think you're going to get a better chance to own this stock if you really want to own it at lower prices. So just wait, just be patient, keep it on your watch list. If something bad happens with Coinbase, like a hack, or if it encounters regulatory hurdles or some other problem down the line, you could be setting yourself up for a better entry at lower prices. But again, this is just one IPO that I will not be touching. This looks at the Wall Street Journal and an article that they ran on April 7th warning about SPAC financing. This is the SEC. That's an acronym for Securities Exchange Commission. This is Wall Street's cop or policeman. This is something that they're concerned about. SPACs are blank check companies that do reverse merger, and then they get listed on stock exchanges. It's a faster way for companies to go public and to raise capital. And there's no doubt, there's a lot of speculation in the SPAC marketplace, just as there is in other markets like real estate and cryptos and penny stocks. I mean, you can go on and on. The bigger question I have is this the same concerned SEC that hasn't yet banned illicit pay-for-order flow schemes by brokerage companies like Robinhood and Citadel and others? Never mind SPACs. I say the SEC should start showing us some of their genuine concern by banning subversive pay-for-order flow schemes that go against the investing public's interest. And by the way, the only people who think that pay-for-order schemes are a good thing and that are good for the public are the mob bosses who promote them. Let's take a look at chart 8, which shows us the S&P 500 sector ETFs. And these are the top performers so far in 2021. We've got financials, XLF, energy, XLE, and communications, XLC. And if we look at the S&P 500 by all 11 industry groups, you will notice something very important. All 11 are ahead since the start of the year. That signifies broad participation in the stock market's rise by all sectors, which again, I think is healthy. That's what you want to see if you're a bull. And let me add that even sectors that were previously underperforming and slightly negative have now joined the party. And these are sectors like utilities and real estate that have also been hurt by rising interest rates. Nevertheless, they haven't been hurt much if you look at the action in terms of prices thus far this year. Let's take a look at commodities, which are leading all major asset classes with positive double-digit gains. USCI tracks a basket of 17 different commodities, and it's really those energy components like oil that are doing the best. I also included GBTC, which tracks a basket of Bitcoins in this chart. Even though Bitcoin's not a core asset class, nevertheless, it's performing quite well on a relative basis, and this just kind of gives you a little bit of that look at performance since the start of the year. Next up is April. What kind of month has it been in terms of stock market performance? Well, as you can see from this chart, it's been very bullish going back to 1950. In fact, April is the second best performing month right after November. And most of those gains happened during the first 18 trading days. And so far, April 2021 is following history. And so that's where we're at right now. So a couple key takeaways from today's episode. Be very careful when the market turns greedy. You should probably be doing the opposite of the crowd. We all have all 11 sectors of the S&P 500 in positive territory. That definitely is a bullish sign. But at the same time, it doesn't mean necessarily the stock market is invincible. We could still see a correction, but right now we're seeing broad participation by all industry groups, and that is good if you're a bull. Also, by way of reminder, now is the best time to implement your margin of safety. That's the portion of your portfolio that's earmarked for your cushion. We want to do this in terms of like thinking about the optimal time. We want to do that in a rising market. It's much better than doing it in a market that's correcting or falling in price. And so you think about this in terms of insurance. When's the best time to buy insurance? We do it before the accident or before the storm. And so implementing your margin of safety is very much the same type of exercise. Your timing, so crucial to do this when markets are friendly. And so earmark a little bit of your portfolio for your margin of safety. And like I said earlier, I've got a margin of safety worksheet in my online classes that you can download to help you calculate how much of your overall portfolio should be earmarked for safety. How did you enjoy today's episode? We talked about a lot of good things. Be sure to subscribe to ETF Guide TV. Don't forget to check out my other programs like the Portfolio Report Card, as well as ETF Battles. I offer online classes plus a portfolio grading service. So get in touch with me if you need some help. I'm DeLegge with ETF Guide TV. Thanks for watching. We'll catch you next time.